This video is for anyone looking to learn more about the basics of Japanese candlesticks in stock charts in just a few minutes. We'll cover the significance of a single candle and patterns over a time frame. This is part of the Late Bloomers investment series, and you'll find more on the basics here on this channel. Please subscribe. Now let's roll the bloom, and we'll get started on these candles. When you pull up a line chart on Yahoo Finance, let's say Tesla, by default, you're probably seeing a line chart like this. We're looking at a daily time frame of 3 months duration. Now, if you go up here to the charting options, you'll see that you have various view options. You can see the pricing as a step ladder like this. You can view it as a mountain. You can look at bars, but probably the most popular now for short-term and day traders is the candle option, what we call Japanese candlesticks. So we'll select that view. Now, why are they called Japanese candlesticks? Because they were first used by Japanese rice traders to track prices back in the late 1800s. They started being used in Western markets only after this book was published by American author Steve Nissen in 1991. Why have they become so popular? Because each candle very succinctly contains 4 crucial data points. They are dense with information and easy to read at a glance. Now, if you're unfamiliar with candles, you're wondering, what in the world do all these red and green rectangles with lines of different lengths sticking out of them mean? That's the question we're here to answer, and 10 minutes from now, you'll know as much as anyone who claims to be a guru. Each candle represents a time frame in the market. It can represent anything from 1 minute all the way up to an entire year. Fat part of the candle is called the body. A line of any length that drops below the body is called the lower wick, and any line above the body is the upper wick. Now, let's say we're looking at a chart of daily time frames in real time. A green body appears right after the market opens, and it's growing. As long as the day goes, you'll see it pushing upward, maybe a little, maybe a lot. At 4 p.m. on U.S.-based exchanges, the market closes, and the top of the candle body will be the closing price. If at any time during the day the price drops below the opening price, it'll show as a lower wick, and the bottom of it will be the low price of the day. If, on the other hand, the price at any point spikes higher than where it eventually closes, that will show as the upper wick. So each candle contains these 4 data points, 4 prices that will tell the story in a nutshell of how the trading day went. A red day is where the price closes lower than it opened, so it's the exact opposite. You may see the price drop a little or a lot throughout the day. If it spikes higher than it opened, even for a minute, you get the upper wick. And if it drops lower at any point, you have your lower wick. And that's it. These candles can look rather average, but bodies and wicks can vary greatly in length. Now, you need to know what a doji is. Doji is a Japanese word that means mistake, but in the context of candles, it means a time frame in which the opening and closing price are virtually the same. As you can see, the body is pretty much non-existent, although there may be wicks in either or both directions. What does a doji tell you? Well, in a market that isn't really showing much of a trend up or down, it may not mean much of anything. If you see a bunch of dojis or near dojis in a row, it just means there isn't much movement and there's no telling what might happen next. If you see a doji at the top or bottom of a strong trend, it could be an indication of a reversal, a stronger likelihood that the price will start going in the other direction. Bullish patterns of multiple candles include the hammer, which is a near doji starting a reversal at the bottom of a bearish trend. A marubozu is a long, wickless body where the price never dropped below where it opened and it closed at its high point. This is considered a strong indicator of the likelihood of continued upward price movement. Neutral signals include individual spinning tops and dojis that don't really point the way to movement in either direction, and it might be wise to wait until the price breaks more clearly in a certain direction before trading. Periods of neutrality should always be considered within the context of higher time frames. Bearish patterns include the red marubozu, the hanging man, and the shooting star, signaling the potential end of bullish trends and price reversal, in the short term at least. The bullish engulfing pair is when a red time period is completely engulfed by the next time period where the price actually opens lower than the previous time, but ultimately closes higher. This is considered to be a strong bullish signal where buyers have taken control from sellers. Similarly, the tweezer bottoms pattern is where you have the price opening close to where it closed the previous day, but then heads strongly in the opposite direction. The piercing line is when the price opens even lower than the previous close, but then closes above the midpoint of the previous body. All three of these patterns show a potentially sharp reversal in the balance of power between sellers and buyers. These bearish patterns are actually the exact inverse of the three bullish ones we just looked at. In this case, the bearish version of the piercing line is ominously called dark cloud cover. The concept is that the short-term trend of the first time period is dramatically reversed in the next one. There are more fun ones here. The morning star is where you see a long bearish candle followed by a short-bodied, almost doji-like candle that signals indecision. Since that kind of candle very often represents a turning point, we hold our breath to see what's coming next. If it's a strong green candle next in line, that's a bullish signal. 3 white soldiers is where you get 3 healthy green candles in a row with higher and higher closes. This is a strong sign a reversal has taken place from the bearish pattern and that buyers have retaken control. 3 inside up is where the red candle is followed by 2 green, with the second one closing higher than the original red candle's open. Again, the bearish versions of those are the inverse, with fun names like Evening Star and 3 Black Crows. Now, I wouldn't be a responsible educator if I didn't make 3 crucial points about candlestick chart patterns. Number 1, candlestick charting is for short-term traders. If you're a long-term, slow-burn, buy-and-hold investor, these charts are simply going to be TMI. Too much information, more than what you need. These charts are for traders who are interested in how much they can profit in the next few minutes, hours, or days. If they're smart, they'll have set a risk limit so they know exactly how much their loss will be if things don't go their way. Number 2, traders have been using candles for more than 30 years now in U.S. markets. There's plenty of proof that they indicate price direction more often than not. However, just one loss can eliminate many gains if you don't have a sound strategy and firm rules for stop loss and position size. In addition, there are other chart indicators you can set up to get what you might call second and third opinions that confirm a developing pattern. Those are topics for future videos. And number 3, candlestick charting is a method of technical analysis. They should not be used in isolation from fundamental events. For example, you may see a juicy set of 3 white soldiers lined up picture perfect and be ready to throw in a big chunk of your cash. But you're exposed to a bust if you don't know what's going on behind the scenes. Those white soldiers could represent the high hopes and buying pressure associated with an upcoming quarterly earnings call tomorrow. Now, let's say the call happens and the company announces unexpectedly that it fell 12% short of analysts' expectations. What do you think will happen despite the clear pattern of the 3 white soldiers? Well, the truth is, we don't know. But does knowing that the earning call is scheduled for tomorrow change the way you should approach this trading opportunity and how you read the candlestick pattern? I certainly hope so. So what's the best way to invest? Should you simply choose an ETF and outsource your investing decision to indexes and algorithms? Or should you look for short-term opportunities as granular as buying and selling shares of individual stocks on a daily or weekly basis? My argument as a late bloomer is that you should at least be educated and know how to do both before you poo-poo either one. Yes, people who don't know what they're doing lose money in the stock market every day trading. But other people, those who do know what they're doing, quietly beat market indices month after month, year after year. Meanwhile, buy and hold index investors also lose money in the stock market all the time. In fact, 100% of their money is at risk at all times. They just don't think about it as much because they trust it'll eventually go up in value again. And history supports that philosophy, but certainly doesn't guarantee it. Meanwhile, short-term traders get to choose two important risk factors. Number one, how long their money is at risk, and number two, how much of it is risked on each trade. They have the luxury of getting little chunks of their money to work hard for a brief time and a potentially larger return, while the rest of their funds remain in cash as what we might refer to as dry powder. It's two different attitudes, two different sets of knowledge and skills, and there's no reason why you shouldn't become proficient at both. Diversification of strategy is just as important as diversification of assets. That's it for this video. Please subscribe to this channel and the newsletter in the description below. When it comes to learning the different ways to invest, it's better late than never, but it's never too late. My name is Mike, and I'm still here.